This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris. During the week, we're with the Operation Nelson Financial Planning, but on Sunday, we're here in the studios coming to you live, broadcasting the show Dollars and Cents, which is Central Florida's longest-running radio program. Started a long, long time ago by my father-in-law, Jack Nelson, continued today by me, yours truly. On the program today, as always, we have a slew of topics to cover. First and foremost, we will talk about the Dirty Dozen. Every year, the IRS issues out a list of the 12 biggest tax scams that you need to be aware of. So just came out this past week, the Dirty Dozen of tax scams. We'll talk about that. And this may be a sensitive subject for some of you, but we're going to try and raise the question, tackle the issue on the program. And the question really is, are your kids wrecking your retirement? Not talking about little kids, okay, that have obviously some cost. We're talking about when those kids become adults and their need for your resources continues. That can and often does create some stress on your ability to save for retirement. So we're going to give you some food for thought on that, along with perhaps some strategies that you may want to consider employing. And then, of course, we would be living under a rock if we didn't talk about the markets this past week. Obviously, volatility is back. We've got some perspective on that. First, we'll talk volatility, and then we'll talk about the issue that is, of course, driving volatility in the news cycle these days, which is this conversation about tariffs. Talked a bunch about that last week and the week before. But, of course, it continues to be a story, so we will continue to talk about it. And then, of course, we'll take your calls, 407-916-5400, toll-free 1-855-545-1025. So that's kind of the flow of the show, if you will. So let's chew into it, shall we? So this past week, it was, I'm going to see if I can remember the sequence. It was down and then up, 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 and then down. Okay, the markets were this past week. So far, the S&P 500, which is a measure of the 500 largest stocks in America today, although remember, that is not an arithmetic average. That is a market-weighted average. So that means that a company like Microsoft or Amazon or in particular Facebook this past week has a larger component, a larger driver of the performance of the index itself. Okay, those small handful of companies, those four names, actually contribute 10% of the performance of the S&P 500. So one of the things to be aware of, if you're a fan of the indexes, is that they can be more concentrated than perhaps you realize. If you own the S&P 500, you don't just own equal shares of 500 different companies. It is a market-weighted average, which means that those companies that have done best of late contribute a much greater portion to the performance of the overall index. So when you have a news cycle, particularly that's hitting one of those heavier components, i.e. Facebook this past week, with the news stories about how they had been sharing data, shockingly enough, all that fine print that pops up on the screen and you accept or you allow, that has a lot of fine print in it. That basically means that you're giving up a lot of your personal privacy. Anyway, and that's sort of how Facebook makes its money too, is taking that information and kind of creating a profile and then marketing that profile to advertisers. So Facebook's performance had a disproportionate impact on the overall index, coupled, of course, with the other part of the news cycle, which is the trade stuff. So the S&P 500 first quarter of this year moved up or down by at least 1%, 23 days in the first quarter. Here's the comparison. Okay, this is one of the things that we were talking about, particularly at the end of last year, going into this year. Last year was an incredibly smooth year for the markets. Good year for the markets, also good year for your emotional health as well, because the markets weren't swinging up and down and creating much headlines. So far this quarter, the first quarter is now closed, obviously, for 2018. We're into April. If you look at the first quarter of this year, there were 23 days where the market moved by at least 1%, up or down. So that's the definition of volatility, if you will. If the market's moving that much, then that obviously has greater volatility. In comparison, the 23 days that happened in the first quarter of this year is about triple the total that occurred in all of 2017. Stop and think about that for just a second. Triple the volatility for 2017, and we're only one quarter in. So be aware, okay, that for your emotional health and correspondingly your financial health, you may want to look at some of these headlines involving the market with a little bit of a jaundiced type of view. Because when volatility returns in the markets, and by the way, history tells us that this is, in fact, a normal level of volatility, that it doesn't just go away. It does have a tendency to kind of hang around. In fact, here's the statistic we'll share with you. In 9 other years since 1958, so 9 other years since 1958, when the first quarter notched between 20 and 25 days of the 1% move, and remember, first quarter this year was 23, so we're in that range, the remaining 3 quarters all had an above-average number of such days, where the average of those days for the entire year was 86 days with at least a 1% move up or down. So let's just parse that statistic for just a second and highlight just how normal market volatility is. Okay, so the statistic, 9 other years since 1958. Okay, so there were 9 other years since 1958. So that's about a 60-year period of time, right? If I've done my math correctly, 2018, 1958, so it's exactly 60 years. Okay, so good. I'm doing math quickly this morning in my head on a Sunday morning. That's good. So 60 years, right? So I've got out my calculator now on my phone. So 9 years out of 60, that is 15%. 15% of the time. 15% of the time. 15% of the years since 1958, you have had average amount of days with a 1% shift up or down, okay, being 86. So 15% of the time, you got 86 days, 86 trading days, just to get the perspective. So 86, I got to clear the calculator, okay, 86 divided by 250, that's about the number of trading days in the year, okay? It's a 52-week year, you got some holidays, okay? So that is 34%, one-third, okay? So let's get this to understand the statistic, okay? 60 years, 15% of the time, one-third of the trading days had moves of at least 1% up or down. Folks, that's volatility. Does that sound like anything that hasn't happened before? It's happened 15% of the time if you look over the past 60 years. So volatility is normal. And if you think you're going to be able to accurately predict volatility when 34% of the time in these more volatile years, looking at it historically, when 34% of the time the market's swinging up or down by more than 1%, you think you're going to be able to zig and zag and navigate your way through that? No, you're not. Absolutely not. And all it takes is to get that wrong a few times, and you're going to tremendously undermine your performance. We've shared those statistics probably 1,000 times on the program. People don't do as well as the overall markets because people's behavior prevents them from doing that, period. We do have some good news. So if you look at these volatile years, they actually are on average positive years. So you look at these 9 years since 1958, average performance, almost 10%. So volatility, number one, normal. 15% of the time you've seen this level of volatility. 15% of the time, that's quite a bit, right? 15% of the time over the last 60 years you've seen this level of volatility. Of those years, the average, close to 10%. Don't know what's going to happen this year. Nobody does. But it seems to me that the best course of action is to leave your investments alone, to leave your allocation alone, even with volatility. Okay, the markets have a pretty good track record of generating return, but that requires you get through the down days in order to experience the up days and be invested for the entire year. Hope you can do that. Sounds easy, right? Try it. In practice, it's super hard. Good luck. We'll take a break here on Dollars and Cents. This is Joel Garris, News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA 102.5. And then for our friends on the AM dial, we're on 540 AM. On the program, we are, of course, talking a little bit about the market, some interesting statistics we shared with you that hopefully puts volatility into perspective, right? I mean, volatility, normal part of the markets. I don't care what anybody says. Oh, this time it's different. This time it's like nothing we've seen before. Yeah, check the history books. It's plenty of times when volatility has happened. And in fact, it happens much more frequently than you realize once you start hitting the history books. We'll spend some time in this segment talking a little bit about the tariff stuff, hard to avoid and ignore that issue. A war of words back and forth, battling proposals at this point, which certainly are affecting the market. One comment I do have on that is that I think the current administration certainly has a very loud bark, but oftentimes their bite never winds up quite being as dramatic as the bark. And I think that's something that we all kind of need to get used to, because obviously this is a very different administration than any that we've seen in the past. For fans of Trump, they would say that's exactly why we voted for him. For his detractors, they would say, oh, my goodness. But the reality is, just for a little bit of perspective on this trade stuff, and the market's kind of trying to feel this out too. That's why you see the volatility that you see, particularly over the past couple of weeks, where depending upon which way that daily news cycle is bending, the market's either going to be positive or it's going to be negative. So the markets really are trying to work through sort of the read the tea leaves to a large extent. And I think what's most instructive on this tea leaf reading is perhaps the most recent, or the prior to these headlines, the other headlines that we heard a lot about, just over a month ago. It seems like forever, but just over a month ago, where there was the announcement on steel and aluminum and those tariffs. So the announcement for steel and aluminum tariffs occurred on March the 1st of this year. So that was just over a month ago. 6 days after the announcement, okay, again, that sort of made big headlines, but what really made big headlines was the March the 1st announcement. 6 days after that, then the plans were released to exempt Mexico and Canada. So that made a little less news, not nearly as much as the initial announcement. By the time the tariffs became effective, 3 weeks after that, on March the 23rd, a total of 32 additional countries, so a total of 34 countries, are exempt, meaning the tariffs don't apply. And those 32 additional countries included all 28 countries of the European Union, plus Argentina, Australia, Brazil, and South Korea. Further exemptions are expected over the course of the next month. So understand the headline, understand the rest of the story, because the rest of the story is very different than the initial story. And we're starting to see somewhat of a pattern, if we can call it that, that a lot of this is negotiation, conversation, drawing lines, and then ultimately shifting those lines pretty dramatically. And I think one thing you could certainly say about the current administration is that they don't, when they say something, they're making a point, but I also think at the same time that they're happy to back off or to shift gears or something like that. And obviously, a lot of people have frustration with that, but I think the concept is that it's not so much, and you read and study any business management or business strategy books, the important thing to remember on this is oftentimes it's not so much about the quality of the decision. Did you get the decision right or did you get the decision wrong? It's really more about the fact that the decision was made definitively, and then you move on to the next one, you move on to the next one, and you move on to the next one. So what we will see, and ultimately with those series of decisions, you could very well reverse your prior position, which certainly seems to be the case. But I think I would really counsel folks to not read a whole lot into this. There is a high level of mutual dependency that exists between the United States and China. both going back and forth. It is most definitely a two-way street. So I would be careful about trying to read anything into it. We're going to hear a lot more about it, no question at all. So be prepared. And as the statistics that we were sharing with you in the first segment of the program show, once you kind of have something that sort of kicks up volatility, it has a tendency to stick around and generate overall a relatively volatile year, which, though, is actually, if you look historically, something that does happen on a somewhat regular basis in the market. So obviously stay tuned for that because that will be a tremendous topic that commands the headlines. Speaking of topics that command the headlines, if you're not looking at the calendar, you are starting to run out of time if you have not done your taxes. It is April the 8th. Today is April the 8th, which means that the technical deadline is April 17th. So you're down to single digits. Why is the deadline April 17th? Well, it's just kind of how the calendar falls. The April 16th is April 15th, of course, next Sunday is a Sunday. And then the 16th is a federal holiday in Washington, D.C. called Emancipation Day. And so then that means that the official filing deadline is April the 17th. So you're down to 9 days to get it done. And so around this time of year, the good folks at the IRS issue out a list of tax scams that you need to be aware of. And they call it the Dirty Dozen. They do this every year. Some of them haven't changed. Some of them are newer. Some of them certainly did not exist 10, 15 years ago because we live in a very different technological world. So we will dive into those. If one of these applies to you, then you probably need to start sweating. And we'll tackle all of those on that list here in our next segment. So stay tuned for that. Open lines as well, 407-916-5400. Toll free, 855-545-1025. The email, of course, is Joel, Joel, at NelsonFinancialPlanning.com. That's how you can get in touch with us here on the program, Dollars and Cents, with your host, Joel Garris, News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. This is Joel Garris here on Dollars and Cents, News Radio 102.5 WFLA. Covering some territory in the program today. In the first half, we talked a lot about volatility, some perspective, and, of course, the headlines involving trade. This segment, we will shift to some of the tax scams to look out for 9 days before the filing deadline, so hopefully you're thinking about that. And these are the ones to watch out for. Every year, the IRS puts this list out. These are perhaps the most egregious of the schemes that taxpayers may run into that are, in fact, really bad, I guess would be the best way to say that. They also have to remember that you are ultimately, no matter what anybody says, tax preparer or whatever, or friend or uncle or cousin, you, the taxpayer, are in fact always legally responsible for what is on your tax return. Period. The buck stops with you. So make sure that your tax return is as accurate as it can be. Some of these scams are pretty familiar. Some of them may not be. So we'll run through the list real quick for your continuing information. So first of all is phishing. Obviously, that's the potential emails or websites that look like they're the real thing, but in fact are fake. Here's the key concept to remember that. The IRS is never going to initiate a contact with you, the taxpayer, about your amount owed or your refund. They're never going to initiate contact via email, period. So if you get an email out of the blue saying it's from the IRS, it's not from the IRS. That's not how they contact you. So don't click on it. Don't go to the site. Don't put in your information. Don't do it. Another one that's become more popular is rather than getting it an email, then it's a phone. It's a call from somebody impersonating an IRS agent saying you're about ready to be arrested if you don't pay X number of dollars, and they're coming to get you. Hang up on that one, okay? They are not. That's not the IRS that's going to be doing that at all. So watch out for those scams that are electronic based, but also now there's been an uptick in the ones that will contact you by phone as well. Identity theft, obviously a big issue. If you suspect that you've been a victim of identity theft, best to file your taxes using a PIN number. That's one of the changes that the IRS has made of recent. That PIN number basically works like a PIN number on your ATM. It is uniquely assigned to you by the IRS. You don't get to pick your PIN number. They will assign it to you. And in order to file your tax return electronically, that PIN number is needed. So, again, if you've been a victim of identity theft, you may want to request a PIN number on the filing of your taxes to make sure that you are in good shape. Here's another one. Your tax return, the guy that's preparing, or gal that's preparing your tax return, may be not as squeaky clean as you think. There can certainly be preparers out there who ultimately operate scams or ultimately promise inflated tax refunds. Look, if you're asked to sign a blank return, or if you're promised a big refund before anybody ever looks at your documents, or if you're getting charged a fee based upon a percentage of your refund, those are three very specific instances where you really need to get your radar up, because the reality is that that's probably a tax preparer that is acting improperly and certainly inflating your refund for the sake of getting more money back is not a good thing. So again, if you're asked to sign a blank return, if you're promised a big refund before anybody even looks at your documents, or if the fee is based upon a percentage of the refund, those are some alerts that should trigger a little bit of concern in your head where you say, wait a minute, I'm not sure that this guy is really towing the line. So be careful on that stuff. Others on the list of the Dirty Dozen tax scams for 2018, fake charities. There's a lot of charities that are out there that are very well-known charities, but there's also a lot that will attempt to use names that are very similar to those well-known charities and do so in a way to solicit donations when, in fact, it's just a front and it's just a fraud. And be wary of charities that have names that are very similar or sound like more well-known ones. So take a few minutes to really investigate a little bit more about the charity that you're giving to, because there's certainly some fake charities out there. business credits, earned income credits, shifting income around or creating income to make yourself qualify for a credit is never a good idea. Padding your deductions, also not good. Putting down charitable contributions that, in fact, you did not make. Trying to inflate your deductions or expenses, certainly not a good idea. Think twice about before you decide to overstate or try and apply for any credits. Similarly, creating income, earned income credit is based upon obviously having work income. And in order to become eligible for the earned income tax credit, you have to have a certain level of income. And so you might very well invent some income in order to qualify for the credit. Similarly, don't go Wesley Snipes on it, okay? Don't come up with some argument that says it's illegal for me to pay taxes and so I'm not going to pay them. Look, that's just unreasonable and outlandish. And at the end of the day, it's been repeatedly thrown out of court. So don't try some frivolous tax court. It didn't from some frivolous tax argument that says, "Oh, I didn't owe taxes," or it didn't work out very well for Wesley Snipes. He went to jail, by the way, if you don't know the rest of that. And then similarly, your tax shelters, particularly of an offshore basis. Look, okay. Offshore cheating is very high. The IRS is relatively smart, and they have a pretty good track record of tracking that stuff down. So it's sort of a bad bet to want to try and hide money and income offshore. They have been very successful on their enforcement actions against the offshore and shifting money to offshore, along with a lot of other tax structures out there that are that are abusive or intended solely to help reduce or eliminate the tax liability. So some things to be aware of. There's the dirty dozen, if you will. A bunch of things that are probably obvious, right? But all it takes is for you to let your guard down just a little bit, and one of these might very well be happening to you. So make sure that you're paying attention to what's going on your tax return, and for that matter, what's going on around your tax return, because it's a great vehicle for fraud and theft, and so you want to be very careful with that. So we will shift gears a little bit. I want to save the last segment of the program to talk about adult children and the potential impact that they have on undermining your retirement. Not talking about the little kids that you have and they cost money, and yes, we get that. Talking about the adult children that we see often having a significant impact on your finances in your later years. So we're going to talk about that, give you some ideas to think about on that next on the program. Also take your calls, 407-916-5400, toll free 1-855-545-1025. This is Dollars and Cents with Joel Garris, News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars. Hey,
welcome back to the program, ladies and gentlemen. Dollars and Cents here on 540 AM, 102.5 FM, WFLA. So this is going to be a little bit of a sensitive topic, but we'll try and tackle it as well. My children are all still teenagers, so I have not had to deal with this issue yet. But I got 3 kids, so you know what are the odds? Pretty good, right? So here's the statistic: since 1880, this goes back. there are more young adults living with their parents than at any time since 1880. Among 18 to 34-year-olds, just over 32%, 1 in 3, 18 to 34-year-olds, 1 in 3 are living with their parents. That's a big number. That costs you money. That's money that you could be putting towards your retirement, right? That's a pretty significant statistic. What's even more problematic is when it continues in the 40s, 50s, and 60s. That would be the age of the kids. If they're in their 40s, 50s, and 60s, you got a big problem, because now the likelihood of the money that you're giving jeopardizes your very own financial health and future. And at the end of the day, does it really help the kid? Right? I mean, if there's a health problem or a setback of some kind, that's one thing. But often that dependency is based upon a dynamic that still very much continues. 1 in 3 18 to 34-year-olds still living with their parents. The highest level since 1880. I don't even know where they, were they even keeping statistics back that far? So be careful with that. That can kind of happen and just kind of creep up on you, right? Stuff that you started when they were younger, it continues on into adulthood, and at the end of the day, that is creating a dependency for them, which isn't helping them, and also has the ability to fundamentally affect your retirement and your enjoyment and your ability to do what you want in your later years. So we're going to give you some tips. We're going to talk about some things that you can do to perhaps help curb that or help reduce dependency, or maybe try and tackle this issue, because it's a hard issue. I get it. I am a parent. Obviously, my kids are still younger, although they're getting older. Sadly, that means I'm getting older. But these are some important issues, and the cost and the effect that it can have can, in fact, be incredibly significant. So let's talk about gifts, okay? One of the suggestions that to think about with gifts is to make those gifts random, meaning both the amount and the timing of them, so that would reduce that feeling of entitlement or reduce the reliance, right? Oh, at Christmas time, I always get 10 grand from my parents, so I'm just banking on that to help me, cover the cost of the holidays or pay my real estate taxes or whatever the case may be. So if you're giving those gifts in random amounts, with random timing, there's much less of an entitlement mentality and much less of a reliance on it, particularly if the amount and the timing is unknown. Now, when you give a gift, give a gift. The notion of trying to attach strings to it in order to manipulate behavior has a tendency to increase that dependency equation quite a bit. So be careful when you're doing that if you are feeling like making a gift, then in fact you do not attach strings to the gift. Next one. If you want to lend money, make sure that it's a real loan. Right? I've seen it on all too many occasions. Well, I loaned money and it didn't get repaid, or they didn't really think it was a loan, or there was some miscommunication, or what have you. Okay? So when you make a loan to anybody, relatives or not, what you want to do is note that loan using a promissory note. Promissory note is something that they sign, so that when they put their signature on that document, they understand that, wait a minute, this is a loan, this is now documented, and I'm not just going to be able to ignore it, or I'm not going to let the hands of time erode what our conversation was when the money went from party A to party B. A note, you can find them on the internet. Look up promissory note, and you'll see a bunch of different forms. They're relatively simple, relatively straightforward, usually a page or two, nothing exotic. The point is to document it, to determine, make sure that there's an accurate record of the amount, make sure that there's an accurate record of the interest rate, and make sure that they sign it. Because the signing of that creates very clear that, in fact, it was a loan. And at the end of the day, that in and of itself will perhaps increase the seriousness with which the person takes on the transaction. Okay? And then some other thoughts. Make sure that if you are lending or giving, that you do so within your means. Okay? Lending or giving money out of, say, a retirement account is not a good decision because first of all, in order to replace that money, it's got to come back within 60 days. If you're loaning money to somebody, sure, I understand. They may tell you they're going to pay you back in 60 days, but the reality is that there's a much higher risk associated with that. And if the money doesn't get back in and you took money out of your retirement account to loan it to somebody, then you now will face taxes on that amount. So be careful of that, because you can wind up creating yourselves a much greater liability. Very difficult issue to wrestle with, okay? But we've certainly seen it on a regular basis where continuing to support adult children does have an effect on one's retirement. And it winds up becoming a much greater portion and uses up those dollars and ultimately can really reduce down your standard of living in retirement. And the statistics today would suggest that you really need to be on your toes about that, because you've got the highest percentage of 18 to 34-year-olds still living at home with their parents. 1 out of 3 in that age group. And then the dependency that exists then very easily translates over to those older ages, the 30s, the 40s, and the 50s. And then at the end of the day, your retirement dollars are being spent to help them rather than being spent to help you. We have a bumper sticker in the office. In the office, the bumper sticker, which was given to us by a longtime client because it rings very true, the bumper sticker says, "Go first class, your heirs will." They do not have the same appreciation of the dollars that you do, because you were the one who earned them. You were the one who sweated for them. The beneficiary often does not. So be careful as you think about that. So that about wraps up the program. We will get out of here. Enjoy the rest of the Sunday. And if you want to catch any part of the show, or you missed a part of it, or you want to rehear it, of course, we post it up on the various social media networks and our website during the course of the day on Monday. So have a good rest of the Sunday. You've been listening to Dollars and Cents with your host, Joel Garris, here on News Radio 102.5 WFLA.
This is Bud Hettinger. And you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 102.5 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.